The average yield on Nigerian sovereign Eurobond fell sharply in the international market due to sustained demand from offshore investors seeking to take position on recovery hope and U.S. federal rate maintenance. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am your host, Kike. The sovereign asset experience in bullish moments driven by renewed investors' demand across the curve. The November 48, September 28, and September 51 bond saw the most buying interest, resulting in a sharp yield drop. Investment firm Carry Assets Limited says in an investor's note. Fixed income market analysts highlighted the broad-based demand led to 14 BPS decline in average yield on Nigerian US dollar bond. Consequently, the average Eurobond yield settled at 8.80%. African Eurobond rallied, led by strong gain in Nigerian and Egyptian paper as markets welcome an Israel-Iran ceasefire and dovish Fed signals. Chair Powell hinted at potential near-term rate cut despite tariff inflation risk. However, Angola bond underperformed the price level. A slew of investment banking experts explained that the prevailing market trend is likely to continue this week unless unexpected disruption occurs. Market forces Africa reported on Friday that the Eurobond yielded declined by 28 BPS last week. If this inflation continues, demand for bond will continue to increase, price for bond will continue to increase, while yield bonds, including the Nigerian tax administration bill, the Nigerian Revenue Service Establishment Bill, the Joint Revenue Service Establishment Bill, the Joint Revenue Board Establishment Bill, which are recently passed by the National Assembly Establishment Bill, after extensive consultation with various interest groups and stakeholders, will be signed into law on Thursday. When the new law become operational, they are expected to significantly transform tax administration into the country, leading to increased revenue generation, improved business environment, and boost in domestic and foreign investments. One of the four bills in Nigerian tax bill is of doing business, which aim to consolidate Nigerian fragment tax law into harmonized statute. By reducing the multiplicity of tax and eliminating duplication, the bill will enhance ease of doing business, reduce taxpayer compliance burden, and create a more predictable fiscal environment. The second bill, the Nigerian Tax Administration Bill, will establish a uniform legal and operational framework for tax administration across federal, state, and local governments. The Nigerian Revenue Service Establishment Bill, the third bill, repealed the current Federal Inland Revenue Service Act and creates a more autonomous and performance-driven National Revenue Agency. The Nigerian Revenue Service it identified the NRS expanded mandates, including non-tax revenue collection, a layout of transparency, accountability, and efficiency mechanism. The fourth bill is the Joint Revenue Board Establishment Bill. It provides a formal governance structure to facilitate cooperation between revenue authorities at all levels of government, it introduced essential oversight mechanisms, including establishing a tax appeal
that global television can be watched in Nigeria and all over the world.
Download the Global TV Nigerian mobile app for Android and iOS devices to watch global television real-time from around the world. What are you waiting for?
Start downloading and stay connected to global television.
Welcome back. If you're just joining us, it's Business Point, where we x-ray the Nigerian economy and the government policies. All right, let's take a look at the stock market. The Nigerian stock market closed a positive territory on Wednesday, 25 June 2025, with all share index surging by 1,466.87 points to close at 121,257.69%, smashing through 120,000 mark for the first time. This represents a 1.22% increase from the previous day close at 119,790.82, driven by a surge in SWOT likely international bureaus, Zenith Bank and Boa Cement. While trading activities saw a slight dip, volume remained strong with 861.6 million shares exchanged, down marginally from 868.6 million in the prior session. Reflecting the bullish market sentiment, market capitalization rose to 76.7 trillion naira, up from 75.7 trillion naira across 22,896 deals. On the gainers chart, Dan Sugar and Owando led the rally, each posting the maximum daily gain of 10.00%. On the flip side, UPL and Briscoe topped the loser list, shedding 6.25% and 6.12% respectively. Fidelity Bank and Caviton dominated the day's volume chart, highlighting sustained investors' interest in those equity. Caviton followed with 64.1 million shares, while Zenith Bank maintained momentum with 60.6 million shares. Japan Gold and Access Corp completed the top 5, posting 56.2 million and 48.5 million shares respectively. Trading value shows that Zenith Bank recorded the highest turnover at 3.4 billion naira. Adel and Nestle followed with 2.4 billion naira and 2.2 billion naira respectively. Nigerian Brewery posted 1.8 billion naira while GT Coal reported 1.7 billion naira in the value traded. All share index has finally crossed the 120,000 mark, reflecting a strong bullish sentiment and delivering a year-to-date gain of 17.81%. Looking ahead, provided the market isn't seeing overbought, sustained buying, especially in the large cap stocks, could continue to propel the index higher in the session. Decline in funding attracted by the country's innovators in recent times. Going by the minister's plan unveiled upon assumption of office in 2023, this target is to be achieved in 2027 by ensuring a 50% increase in funding each year from 1.2 billion naira attracted by the startup in 2022. However, data from 2023 and up to first quarter in 2025 suggests otherwise as funding continues to decline. At the end of 2023, Nigeria slipped from the top position it occupied for the year to become fourth in Africa as startup in the countries managed to raise about $400 million, marking a significant decline from 2022. In 2024, the country's startup also raised about the same amount and remained among the top 4 in Africa in terms of funds raised for the year. The industry analysts believe a combination of the factors is driving the decline in startup funding not only in Nigeria but globally. These factors include rising global interest rates, a shift in investors' focus, and persistent challenges within Nigerian startup ecosystem. Beyond funding, Nigerian startup face policy challenges. A recent report by Startup Graveyard identified funding shortage as the primary cause of African startup failure in 2023 and 2024. However, beyond that, it pointed at specific challenges in Nigeria, especially in the area of regulation and policies. The report noted that Nigerian startup ecosystem faces unique hurdles, including unreliable power supply and sudden regulatory changes. It added that some startups in the country have changed their business models and developed innovation to suit the current regulatory policies, which have also hindered potential international investment. It could be recalled that the former President Buhari signed the Nigerian Startup Bill in 2022 into law on October 19, 2022 to put an end to the legal uncertainty that had trailed the startup industry in the past. It provides for what qualifies a company to register and obtain startup status. The Act stipulates, among others, that before a company can be labeled startup, it must obtain a certificate known as startup label. This means that the only companies with the startup label will be recognized as startup. It mandates that a startup support and engagement portal should be established to facilitate the issuance of startup and label, and also bridge the gap between the regulators to obtain a startup label. Companies issued with a startup label have obligation under the bill, and failure to comply with this obligation can result in the revocation of their startup label. According to the Act, for a company to be named a startup, it must be a registered limited liability company that has been in existence for not more than 10 years from date to incorporation, among other requirements.